Hi everybody, this is the investing teacher, high school science teacher, teaching others how to invest. In this video, I'm going to go over a review of the 2% a month strategy and the positions I made this week. Also looking at a option calculator that will show your possible percent returns depending on the day and expiration. And we'll look at some user questions and 2 possible positions to do for Monday. Let's get right to it. Okay, here are my positions in the spreadsheet I made. I did color code these. So the ones that are in black are closed positions. That means I sold a cash secured put and then I bought to close. The purple ones are open positions, meaning I did the trade not this week, but the week before or even before that. And I still currently have those positions. And the blue ones are this week's trades. So look at the purple ones first. My open positions are still Palantir for February 12th. Premium was $369. Right now, I could buy back at about $200. So I would get a little under 50% gain, but I'll let that sit a little bit because the strike price at 25 and the current price is about 26 or so. So I'm going to let data decay and let that go down a little bit more. COTY hasn't been moving much at all in the option price. I'm going to wait until February 5th for a $19 premium. I could buy it back around 19 right now. I have CLOV, the $124 premium, but that is February 19th. I have DGLY, which I did the week before, 4 positions at 219. Strike price is at 2.5 and the stock's already at 2.6. So this is one that I probably will have to sell covered calls on in the future. Dropbox was made 2 weeks ago. It's going to expire today on 1/22 when I'm making the video. Strike price at 22, and this will be one that I might have to cover call or I might not because the stock's at 21.96 or something like that. Trades that I made for this week. One was AMC, did 2 positions, pretty small. Strike price at 2.5 when the stock was at 306. I made a $38 premium. Then I decided just to buy to close it at 16. So I made half the profit in about 2 days. KALV was from a user on Facebook, which has a really high premium of $374. This will expire 2/19. Strike price at 15, $3 under the price when I made it. The stock's already down a little bit to around low 17s. CODX is one that I made, and a PHA. Both these I made for the end of January, so then I could open up more positions in early February. For CODX, $21 premium, and a PHA, $34 premium. So these are my open positions. When I look at my profit and losses for any of the closed positions, all of them so far have been positive, which is definitely good to see. The only one that was negative was my PLTR when I rolled it in the newer position. Total profit right now is $1,394. What that means is if all of my positions that I currently have open expire worthless, this will be my total profit. Obviously, that's not necessarily going to happen. I might have to roll them. I might buy to close if I could collect profit and whatnot. Total amount invested is $11,250. I'm trying to keep at least to the $10,000 plus whatever I'm making in premiums. So I'm actually slightly lower than what the total profit is. Next, I want to go over some user questions. These came from the Option Wheel Facebook group that I'm a moderator of. Feel free to leave any questions on that group or in any of the comments down below. I'll read all comments and respond to them and possibly do a video with quick or detailed analysis on it. One, we're going to look at how to find high implied volatility stock, and we're also going to look over mean reversion on how share prices could many times go back to the mean. Okay, the resource I use to find high implied volatility stocks is swaggystocks.com. And you look at the FD ranker. So if you go to FD ranker, you can select the ticket symbol below. If you want high IV stocks, just click the IV button. It's already automatically at the high IV stocks. So this could be an initial source of research. CEO right now is 238% IV, Riot 176, AMC, which is one of the positions I made, was 170. GameStop's been very popular on Wall Street Bets, 170 as well. So these options in general will pay very high premiums. That doesn't necessarily mean that they're safe. They're going to be moving a lot compared to this price, but it is a good initial source of research to do more further examination. Next, I want to briefly go over mean reversion. The definition of mean reversion is the theory used that asset price volatility and historical returns eventually will revert to the long-term mean or average level of the entire data set. So what that means is if you see a stock tumbling, going down 15, 20% in a few weeks, there's a pretty good chance that it's going to bounce back to the positive. One of the main strategies that I use and many others use is to sell a cash secured put on down days. That's when the company is down lower, because the cash secured put premiums will be higher. A lot of people are thinking that the stock, if it's falling down, will continue to fall down. And again, in the short term, it might do that. But in the long run, a lot of times, it will revert back to the mean. So let's say that there was a stock that you were looking at with a share price of currently at 20. Let's say it dropped down to 17, and then you're thinking this would be a good time to sell a cash secured put. You might want to sell a cash secured put at, say, 15. Give yourself a little bit of buffer from the current price. And there would be a pretty good chance in most cases that the stock will either stay around 17 or maybe move back up to closer to 20. If mean reversion happens right away and it bounces back up to 20 pretty quickly, you could buy to close your option at a profit very quickly as well. And that's what I was doing with some of my positions earlier. If the stock price goes up 3-4% in a few days, then the option will most likely be worthless, and then you could just buy to close and move on. All right, finally, I want to go over a option calculator that is very useful. If you go to optionsprofitcalculator.com, there's a description down below. You type in the stock symbol. It'll give you the current price of the stock. So PLTR, current price is $25.96. Then you could select the option that's available. Click your expiration date. So for instance, if we're doing a $24 strike for next week, click select option. You could pick a graph range, it'll auto make it for you, but I'll do from 20 to 28 or so. And now it'll show you the amount of profit that you can receive for this position for each day. So from January 22nd all the way to January 29th, the total profit is $52. That's if the stock stays above your strike price of 24. So you get a 2.21% gain. If it's slightly less than 24, you could still make a profit of $23.67. And then here we're starting to get in the negative if it drops much lower. So by using this, you could look at visually what would be in the white or what would be in the red to see different positions and how the stock price, or sorry, the option price will change over time. This is based on the implied volatility of the stock. Now it's assuming the implied volatility will stay the same throughout this week. However, that's not always going to happen, but we can't predict exactly what the implied volatility would be. For instance, if you see the stock's around 26, if the stock goes up to 27 within a few days, you could make a $39 profit in just those few days, because it's going to be much harder for a stock at 27 to drop all the way to 23 in less time period. And you'll make almost $52 if it hit 27 a day or two before the expiration date. This shows the percent up and down compared to the current price. So for PLTR, for instance, it could go down 7.6% in this week, and you'll still receive the full return. So a good little graphing calculator pretty much to determine what might be good options in terms of your risk tolerance. Next, I want to look at two possible positions for January the 25th. One of them is for Dropbox, DBX. Current price $21.94. I sold a cash put for 22 when the stock was at 23. So it did go down a bit, which also might show it could be reasonable for mean reversion. One possible option will be the $21 strike for January 29th. You can make $38 in the trade. When you calculate it, it'll be a 1.84% return, and the stock price could go down 4.3% in the week, and you would still receive that 1.84 $38 return per position you make. If you want to be a little bit more reasonable in the strike, we could go even lower than 21. If we go to, say, 20, you have a much larger down to still earn your profit. You could go down 8.8% in a week and still receive your full return of 0.7% for the week. So this is a reasonable one that's very close to my 2% a month strategy. If you do 0.7%, and I could do that every week for 4 weeks, you're at 2.8% for the month in just that position, with a good amount of flexibility in that downturn. Again, 8% in a week is a pretty big drop, and you could still receive the full return. Another possible position is Blink. Blink's currently at 46.05. You could sell a 1 week expiration at 40.50, and you would receive $115 for this position. If you look at the graph range, you could go down 12.1% in the week and still receive your full return. You could still net profit even at 14% down in the week to 0.38. Now just remember, these are high implied volatility positions, but it might be a possible consideration for you to do more due diligence and see if this options might be appropriate for you.